Welcome to the deep dive. Today we're taking a stack of sources, primarily drawn from a really excellent financial literacy textbook, curated by experts who genuinely, campaign for people to be better with their cash, and we are cracking open the absolute foundations of personal finance.
And if you're joining us expecting, I don't know, a dull lecture on spreadsheets, you're in for a bit of a surprise. Our sources make it crystal clear that money it's so much more than just a financial issue.
Oh,
It's a
no.
profound element of life. I mean, problems here can quickly infect your mental health. They can create just insurmountable strain on relationships and seriously undermine your work life.
hmm
So this deep dive is about recognizing that risk and, well, equipping you with the knowledge to mitigate it.
Our mission today is basically a shortcut to being fundamentally well-informed. We want you to be in the knows, not in the know-nots. So we're exploring the essential pillars: saving, budgeting, borrowing, risk, and security.
And by the end of this, you should have a toolkit for financial independence. The goal isn't just to understand the mechanics of finance.
No, it's the bigger picture.
It's the bigger picture. It's understanding the crucial long-term impact of every single financial choice you make. It's about building a foundation that can, withstand real-world pressures.
And the best place to start that foundation has to be with the simplest, yet maybe the most crucial habit that underpins all stability.
The act of saving.
Exactly. Okay, let's unpack this core concept right away, because the sources draw a really sharp distinction between saving, the verb, the action, and savings, the noun, the result. And I found this clarity is actually incredibly helpful.
It is, isn't it? Saving is the active process. It's either physically putting away money for future use, like making a transfer every month.
Or it's the other side of the coin.
Right. It's the active reduction of spending in your current life. You are saving money when you spend an hour finding a cheaper utility provider, or when you finally cut that streaming subscription you haven't used in 6 months.
And savings, with an S, that's the pile, the accrued amount, the accumulated value.
Yep. So if you initially set aside £50, that's your initial savings. If you then actively save a further £10 a month by, say, cutting your daily takeaway coffee habit,
A classic example.
a classic for a reason, the active saving over the year amounts to £120. You add that to your initial 50 and your total savings are now 170.
It shows that both the big action and the small, consistent actions contribute to the final health of your personal balance sheet.
And the sources outline 4 fundamental reasons why people even do this, why we engage in this behavior. And they cover the full spectrum of financial needs, from, short-term goals to long-term survival.
Okay, so what's number one?
First is saving for a very specific purpose or to achieve a particular goal. These are the big-ticket items: funding a university education, paying for a wedding, or, the big one, accumulating a house deposit.
The things you're actively, consciously working towards.
Mhm.
Highly motivated targets.
Exactly. Then second, you save to gather wealth for future use. This is a bit more abstract. It's the long-term approach. Think retirement planning or just, accumulating assets so that you have more options later in life.
So you can maybe move to part-time work or start a new business down the line.
Precisely. The third reason is, I would argue, the most critical for immediate stability:
The emergency fund.
the emergency fund. Putting money aside for unplanned events. Life will inevitably throw financial curveballs: a sudden car repair, a broken washing machine, an unexpected medical bill.
And without that buffer, those unplanned events force you straight into borrowing, often at really high interest rates.
Which just starts a nasty cycle. And finally, the fourth reason is simply to keep your money safe. This moves us right into the conversation about where you actually store your cash.
Right, because keeping a few quid at home is one thing, but as that amount grows,
The riskier it becomes. It's exposed to risks of being stolen, lost in a fire or a flood, or just being incredibly difficult to track and manage. And that is why we rely on financial institutions.
they manage risk at scale. The source material notes, just in the UK, there are over 300 banks and 45 building societies, all of them competing to offer you a place to store and, crucially, grow your money.
And this leads us to a surprisingly modern tip from the sources, one that directly addresses that very human reluctance to save manually.
We're not just relying on physical piggy banks anymore.
Far from it. Many mobile apps, the sources mention examples like Chip, Plum, Monzo, they're all pioneering these auto-saving schemes.
So how do they actually work?
They essentially automate the difficult decision for you. They link to your current account and use a couple of main techniques. One is rounding up your everyday payments to the nearest pound and just sweeping the change into a separate savings pot.
So you buy a coffee for £3.40. The app saves 60 pence. You barely even notice it.
You don't. The second technique is a bit more advanced. It uses algorithms to analyze your spending patterns and your income flow. It identifies times when you have a surplus balance just sitting there unused, and it automatically moves a small, manageable amount into savings for you.
From a behavioral finance perspective, that's fascinating. You're removing the friction. You're automating the act of saving, so it helps people overcome procrastination.
It does, but it raises a really interesting question, doesn't it? If we rely on an app entirely, does that stop us from ever truly engaging with our financial habits? Are we sort of outsourcing financial literacy instead of building it ourselves?
That is the core tension. The tool is powerful, but you still need the underlying motivation. But whether the money is saved manually or automatically, the true reward you get for saving and the true cost you pay for borrowing is interest.
Interest. Defined as the reward you get for keeping your money with an organization, or conversely, the cost you pay when you borrow their money. It's always calculated as a percentage, the interest rate.
And to really get your head around its magic, you have to understand the absolutely revolutionary difference between simple interest and compound interest.
Let's start with the simple version, although, as you said, banks rarely use this to pay savers today. The simple interest formula is really straightforward. Interest equals principal times rate times time, P times R times T.
Okay, so walk me through it.
If you deposit £1,000, that's your principal, at a 2% rate for 1 year, the resulting interest is £20.
Simple enough.
And the key feature of simple interest is that you would earn £20 every single year on that original £1,000, no matter how long you save it. So over 3 years, you'd earn exactly £60 in total interest.
Okay, that makes sense. But now for the real game changer, compound interest. Financial advisors sometimes call this interest on interest on interest. I've even heard it called the eighth wonder of the world.
It's not an exaggeration. This method recognizes that at the end of year one, your total savings aren't just £1,000 anymore, they're £1,020. So in year two, the interest is calculated on that new higher amount.
So let's walk through that same example. £1,000 at 2% over 3 years, but this time it's compounded.
Okay, year one, £1,000 earns £20 interest. Your total savings are now $1,020.
Right.
Year two, the 2% is now calculated on that $1,020, which yields £20.40 in interest. So your total savings are now £1,040.40.
I see where this is going.
Year three, the 2% is now calculated on that new total, yielding £20.81. Your total savings at the end of the 3 years, £1,061.21.
Okay, so let's compare those results. Simple interest earned you £60 flat. Compound interest earned you £61.21. The difference is just £1.21. It seems, I don't know, negligible.
On a small balance over a short term, yes, but that tiny difference is everything. Because over longer periods and on larger amounts, that growth curve becomes exponential. It snowballs.
The sources show this pretty dramatically with something called the multiplier method.
Yeah, for anyone who's mathematically curious, it's just a way to simplify decades of calculation. You take your principal and you multiply it by 1 plus the rate, raised to the power of the time period.
And the power of that is staggering. The source shows that saving £50,000 at 2% over 15 years
results in a total interest earned of £17,293.
Wow.
That's nearly a fifth of the original principal generated purely by earning interest on previously earned interest. That's the compounding effect in action.
So why do banks even do this? Why do they pay us interest at all?
It's their business model. They do it to attract our deposits, our savings, which they then lend out to other people.
But at a much higher interest rate than they pay us.
Exactly. That differential is where they make their profit. So, for example, a bank might pay you, the saver, 2% interest to attract your deposit, but they'll charge a borrower, say, 10% for a loan.
So if I deposit £1,000, the bank pays me £20. But when they loan that same £1,000 out,
they receive £100 in interest from the borrower. Their profit on your money is the difference, £80.
And that right there establishes the fundamental golden rule of personal finance, which I'm sure we'll come back to when we talk about debt.
Absolutely. It is always, always better to be the lender, the saver, than the borrower. because the interest you pay to borrow always costs you more than the interest you earn by saving.
Okay, so moving from saving to the other side of the equation, spending. This is where we really start to apply this foundational knowledge. And it starts, as all finance does, with that absolute basic split, needs versus wants.
Needs are your absolute necessities for survival and, stable living: food, shelter, essential transportation. Even within these, you still make choices that impact the price, like which brand of cereal you buy, but the basic necessity is there.
Whereas wants are the optional items, the services, the experiences you'd like to have if you have the disposable income.
And everyone knows the difference between needing a loaf of bread and wanting a designer handbag. But the genius of modern marketing and consumerism is making us feel that a want is a need.
The source raises a great discussion point here. The smartphone.
Yeah.
Is it a need or a want?
And the answer is, it depends. It's not static. It depends entirely on the context, your age, your location, your job. For a university student who needs timely security updates and online class access, or a professional relying on it for global communication.
It leans very heavily towards being a need.
It really does. For others, if it's primarily used for high-end gaming or just scrolling social media, it remains a luxury item, a want. The line blurs based on your circumstances.
But what's truly fascinating is the number of external forces that are actively influencing those wants, constantly pushing them closer to the essential column in our minds. The sources detail 6 key influences.
And we should probably explore the psychological power behind each one. First up, family habits. We often just absorb money habits and spending patterns from our parents or older siblings without even thinking about it.
So if you grew up in a family that always buys the most expensive brand name products, you're likely to internalize that preference. You see generics as inferior, even if the quality is identical.
Exactly. Second is peers and social media trends. This is a massive one today. We are social creatures. We're driven by this desire for acceptance. When influencers endorse products or celebrities show off a specific lifestyle, it creates powerful aspirational wants.
And these campaigns often manufacture an artificial scarcity or urgency. Limited edition drop, act now or miss out.
Which completely bypasses rational thought and just encourages immediate, often expensive purchases.
Okay, what's third?
Third is culture and religion. This affects our view of money, saving, and how it's spent. It often dictates major life expenditures like weddings or traditional celebrations.
Then fourth, seasonal events, Christmas, Eid, Diwali. These all promote spending on certain items at specific times and often pressure people to spend way beyond their means to meet social expectations.
Fifth is advertising. This entire huge industry's primary function is psychological manipulation. It's to create wants in our minds. They don't just sell you a product.
They sell you the improved version of you that you'll become by owning it.
Precisely. They push new fashion trends or gadgets so aggressively that your existing, perfectly functional items suddenly feel inadequate, old, embarrassing even.
And finally, number 6, disposable income. This is just the money left after all your bills and committed costs are paid.
And the more readily available this money is, the more likely you are to buy things you don't really need, simply because the funds are sitting there waiting to be spent. That availability just lowers your internal resistance to impulse buys.
So recognizing these external forces is the first step towards getting back some control, which brings us to the formal process of budgeting. Managing that precise balance between your income earnings, gifts, selling stuff, and your outgoings.
A budget is an essential tool. It's a plan. It ensures your money covers necessities first, then priorities like paying off debt, and finally your future savings and any discretionary fund.
The mechanics of the simplest budget are pretty straightforward.
Yeah.
You just compare what comes in versus what goes out.
We can use Robin's weekly budget example from the sources. Her income is £94 and 63 pence, and her expenditure is £84 and 19 pence. So she has a surplus.
But that difference, even though it's small, has to be actively managed. It needs a job. It can be used for debt repayment, savings, or investment.
But if the situation were reversed and her spending is higher than her income, she'd immediately need to take corrective action. That means either cutting her spending or, if the overspend is chronic, looking into cheaper borrowing options to manage the shortfall until she can increase her income.
And as you enter adulthood, especially when you move out and take on more complex financial obligations. That whole process becomes much more complex because your expenses split sharply into two key areas.
Committed versus discretionary spending.
Explain the difference.
Committed spending is your non-negotiable obligations. Rent or mortgage payments, utility bills, gas, electricity, water, necessary food, essential insurance. These are costs you simply must pay to live stably.
And discretionary spending is everything else. It's optional. Gym memberships, streaming subscriptions, leisure activities, holidays, eating out.
And the sources really stress that moving out almost always increases your committed spending dramatically, which means the proportion of your income you have left for discretionary fun shrinks a lot.
Let's look at the Awuramina case study. It's a perfect example because it represents that precise moment when abstract finance hits real-world committed costs for a young professional.
Yeah, she's a graduate, first job, earning £1,540 a month net. Her committed costs immediately swallow a huge chunk of that.
She's got $550 for rent, about $65 for utilities, another $27.50 for water, and $23.87 for essential insurance. Her weekly food shop is budgeted at £220 a month.
That totals around £886 just for the absolute necessities.
Then she adds discretionary things, £19 a month for entertainment subscriptions, for music and movies. So her total outgoings are high. Now, let's say her goal is ambitious. She wants to save for a car. That's a large purchase. It needs significant savings.
If she finds she's not saving enough, she has to act. And this is where the budget moves from just being an accounting exercise to a psychological challenge. The sources outline exactly where she could cut to free up cash.
Cancel the £19 subscriptions. Reduce her leisure and going out budget by half. Stop buying clothes and take away coffee for a while.
And by making those discretionary cuts, which are painful because they involve giving up things she enjoys, she could potentially save an extra £279 a month.
Which means she can reach her goal much faster. She could potentially buy the car and cover the insurance within a year. It's a perfect illustration that even with a decent income, achieving big goals requires being ruthless with your wants.
And once you've set a budget, tracking it rigorously is the only way to ensure you actually succeed. The source suggests 3 excellent practical methods for sticking to it.
From the traditional to the very modern, what's the first one?
The first is using multiple money pots. This involves separating your income, either physically or in separate digital sub-accounts, into different categories: travel, clothes, food, whatever.
So you allocate the budgeted amount to each pot at the start of the month. The key benefit here is visual management.
Totally. When the clothes pot is empty, you stop buying clothes. It doesn't matter how much cash is left in your main account. That money is for something else.
Okay, method number 2, the classic.
The cash book. This is a simple, detailed record of every single transaction income and expenditure that you maintain to provide a running balance. But the most crucial step here is reconciliation.
What's that?
Regularly comparing your cash book against your actual bank statement.
Yeah.
Ticking off every transaction one by one. This process helps you catch forgotten direct debits or maybe even identify transactions that might have been fraudulent.
And the third, and probably the easiest for daily life today,
is using budgeting apps. These just leverage technology to simplify the cash book principle. They often synchronize automatically with your bank accounts. They provide instant categorization, real-time history, and accurate overall balance. It makes tracking instantaneous and massively reduces human error.
Okay, so a final point on spending. We have to master the art of value because price is not a guarantee of quality. And achieving financial stability often means maximizing the value you get from every pound you spend.
Research is non-negotiable here. You should habitually use comparison sites for complex purchases, insurance, utilities, travel, but even better, compare the comparison sites themselves. They don't always offer a complete market picture.
Read reviews to gauge quality and long-term value, not just the initial ticket price. And never, ever accept an automatic renewal of a contract, mobile phone, utilities, insurance, without checking the current market first and trying to renegotiate.
And the ultimate tool for value in the supermarket is the unit price. This is the cost per kilogram, per liter, per item. It helps you objectively find the best deal, even if the total price of a product seems higher because it's a bigger pack.
But the sources do caution us against falling into that too much is better trap.
Oh yeah. If you buy a massive pack of fresh food because the unit price is low, but half of it goes bad before you can use it, the unit price per useful item has actually increased dramatically. Value always has to align with the genuine need.
And as a consumer, You have powerful protection under the law that helps you recover value if goods are substandard. We need to remember the acronym LOF.
LOF. Goods and services must last a reasonable length of time, be of satisfactory quality, be as described, and be fit for purpose.
And the Consumer Rights Act backs that up. If a product fails to meet those standards, you're protected. If you return an item within 30 days, you're typically entitled to a full refund.
And beyond 30 days, the supplier is usually allowed to offer a repair or replacement first before issuing a refund.
And crucially, for online shopping, you have extra protection. The cooling off period. You have the right to cancel even if you just change your mind.
That's right. 14 days after you receive the goods, or 14 days after placing the order for services. Knowing OAHAFE and your rights can save you hundreds, if not thousands, over a lifetime, just by making sure you get what you paid for.
Okay, now we completely flip the financial script. We move from saving and spending our own money to borrowing someone else's.
Yeah.
Which, as we established with that bank profit model, always comes with a high cost and potential risk.
When you borrow money from any regulated institution, you are obligated to repay three distinct components. First, the principal, which is the original sum you borrowed.
Yeah.
Second, the interest, which is the cost of borrowing. And third, any associated charges or fees, like arrangement fees or late payment fees.
And just as compound interest is this powerful force for growth when you're saving.
It becomes a devastating liability when it's applied to debt. You're paying interest on interest you already owe, causing the total repayment to just balloon rapidly.
The sources have a pretty stark example for this. If you borrow 1,000 pounds at a very high but not uncommon interest rate of 20%.
Compounded over 3 years. And assuming you make no repayments during that time, the total amount you have to repay shoots up to 1,728 pounds.
So you've paid over 70% of the original sum just in interest.
It's a stark warning. It visually demonstrates how quickly interest accumulates when you're in debt, especially when the rate is high and the term is long. This is why you absolutely have to understand the true cost of borrowing.
And the key metric for comparing borrowing products is the annual percentage rate, or APR.
APR is mandated to represent the total cost of a loan, including the interest, and any mandatory charges expressed as a single percentage rate over a year. Its whole purpose is to make all loans comparable, apples to apples.
And we contrast this with AER, the annual equivalent rate, which is used for savings accounts.
Right. So if you're comparing two loans, the one with the higher APR is the more expensive option, assuming all the other terms are the same. It's the number to look for.
Now, financial experts commonly divide debt into two very important categories: good debt versus bad debt. And this isn't about morality, it's about utility.
Exactly. Good debt provides an ongoing benefit, or ideally, a financial return. So things like mortgages, which give you housing and asset growth, or essential student loans, which should lead to higher earnings potential.
Or even some well-managed business loans that allow for expansion and profit. These are debts that should, in theory, enhance your long-term financial position.
Bad debt, on the other hand, provides neither an ongoing benefit nor a financial return. This is debt you've accrued for trendy clothes, impulse buys, luxury items, or using high-interest credit cards to cover your routine daily costs.
And this brings us back powerfully to that golden rule we established earlier.
Because the bank makes its profit on the difference, the interest you pay to borrow always costs you more than the interest you earn by saving. Therefore, if you have accumulated bad debt, the clear financial strategy is to prioritize paying it off before you start saving seriously.
Okay, let's break down the main borrowing products available, starting with personal loans. These are relatively standardized.
A personal loan is money borrowed for a general, non-specified purpose. A new kitchen, a holiday, consolidating other debts. You typically pay them back in fixed monthly installments over a set term, usually 1 to 10 years.
And these can be classified as either secured or unsecured. What's the difference?
A secured loan requires collateral. You put up an asset, like your home or your car, as security. This reduces the lender's risk, which means they give you a lower APR.
And an unsecured loan
Has no security. The lender is taking a much greater risk, which means they charge you a significantly higher APR.
Okay, then we have credit cards, typically for those 18 and over, allowing you to borrow up to a set limit. They offer undeniable convenience, but they require serious discipline.
They do. But a major benefit, particularly in the UK context highlighted by the sources, is the robust consumer protection offered by Section 75 of the Consumer Credit Act.
This protection is vital. It's a really important thing to know.
It is. It means that purchases you make between £100 and £30,000 on a credit card are protected. If the retailer fails, goes bankrupt, or gives you substandard goods, the credit card provider is jointly liable and has to refund your money.
It's an invaluable layer of consumer safety that debit cards just do not offer.
But the massive, massive downside is that compounding effect of high interest if the debt isn't cleared every month. And the sources issue a stark warning about only making the minimum monthly payment.
That's usually a tiny percentage of the balance, isn't it?
Tiny. And the example given is chilling. If you borrow £3,000 on a typical card at age 21, and you only ever make the minimum repayments each month,
You could be nearly 50 years old before that debt is cleared.
and you would have paid multiple times the original amount in interest alone. It is a decades-long financial trap.
Right. What about overdrafts?
Overdrafts are another common tool, but they're designed purely as short-term solutions through your current account. And understanding the difference between arranged and unarranged is absolutely paramount.
Okay, explain.
An arranged overdraft is negotiated and agreed with the bank in advance. It gives you a certain limit and typically costs less. An unarranged overdraft happens if you spend money you don't have without permission or if you go over your arranged limit.
And that leads to much higher fees, penalty interest rates, and it often damages your credit file.
And we have to mention high-cost credit, which often targets people in immediate need or those with poor credit histories. This includes payday lenders.
These offer extremely short-term loans, right?
Yes, but the catch is the astronomical interest rate. While there are regulatory caps now, interest rates can still hit potential APRs of 1,499% or even higher.
It's almost never a financially sound decision.
No, it often traps vulnerable people in a cycle of needing a new loan just to pay off the interest from the last one. And the most dangerous form of borrowing is from loan sharks.
These are illegal.
Completely illegal. They operate outside any regulation, they have no consumer protection, no limits on interest rates, and they use predatory, often coercive, collection methods. They must be avoided at all costs.
Okay, finally, let's discuss the unique beast that is the student loan. This is a highly specialized form of financing for higher education, and it's fundamentally different from commercial debt.
The mechanics are designed to protect lower earners. Repayments only begin once you've left university, you're in a job, and you're earning over a fixed threshold. Based on the source data, that threshold was £27,295 for the 2021-22 academic year.
And you don't pay back everything you earn over that.
Not at all. You only repay 9% of the amount you earn above the threshold. So if you earn $30,000, you're only paying 9% of the £2,705 difference.
And if your income drops below the threshold later on,
Repayments stop automatically. This functionality leads many people to argue it's structured more like a graduate tax linked to earnings than a conventional loan.
plus, if you never hit that earning threshold, you never pay a penny back. After 30 years, any remaining debt is legally wiped clean.
And this is arguably the most vital piece of information for young adults planning their future. Student loans do not go on your credit files. They will not negatively impact your creditworthiness when you apply for major commercial debts, like a mortgage later in life.
That's a huge difference from unpaid credit card balances or personal loans.
A world of difference.
Okay, so moving from fixed costs like debt, we now enter the world of uncertainty. Financial risk. Financial risk means the outcome is uncertain. There's the possibility of a significant gain, but also the possibility of a total loss.
Leaving you worse off than when you started. And this helps us define that fundamental difference between saving and investing.
Saving is protected. It's guaranteed. It grows via interest.
Whereas investing involves taking a calculated risk. The value can fall, you could lose some or all of your capital, but the potential for much higher returns is what attracts investors.
So the decision to save or invest really comes down to your time horizon and your tolerance for that risk.
Absolutely. If you need the money in less than 5 years, saving is usually the safer bet. If you can leave the money untouched for 10 or 20 years, investing offers better potential for real growth that can outpace inflation.
So let's explore the common investment types detailed in the sources, starting with shares.
A share represents a unit of ownership in a public company. When you buy a share, you are now a part owner of that entity. And this is high risk, high reward.
If the company does brilliantly, the value of your shares goes up and you can sell them for a profit. You might also get income through dividends.
Right, which is a slice of the company's profits distributed to shareholders. However, the value of individual shares fluctuates daily, often wildly, based on market sentiment, news, economic data.
If the company performs badly, the stock price can drop dramatically. You could lose everything. It requires a long-term commitment and real market knowledge.
Which is why, to mitigate that steep risk, many non-expert investors opt for collective investments. These are often called unit trusts or mutual funds.
So what are they?
They're financial products managed by experts who pool money from lots of investors together. They then spread that risk across a diverse portfolio, a mix of shares, bonds, commodities, property.
So that diversification means that if one part of the portfolio falls in value, say the commodity market dips, it might be balanced out by growth in property or bonds.
Exactly. It's a significantly lower risk approach than trying to pick individual winning shares yourself.
The sources also delve into more modern, high-risk territories like cryptocurrency. The case study of Sandeep and Noor really illustrates the extremes here.
It does. They saw that a specific cryptocurrency rose in value by over 480% in just 1 year.
That potential return is magnetic, but it comes with extreme volatility.
Famously unpredictable. Crypto values fluctuate significantly day to day based on regulatory news, an influential tweet, or just market sentiment.
Furthermore, and this is crucial, because these assets are often bought from unregulated exchanges, there's little to no consumer protection.
Right. If a platform fails or you get defrauded, there's often no comeback, no legal recourse available to get your money back, unlike with shares traded on regulated stock exchanges.
Okay, let's move to another source of financial risk: gambling. This is any activity betting on sports, lotteries, gaming that results in a win or a loss based purely on chance.
And the sources are very clear on this. All gambling is inherently high risk. The entire financial model of the gambling industry is predicated on the fact that the chances of you losing money are statistically far, far greater than you winning it.
We see this with the national lottery jackpot. The chance of winning is statistically minuscule, something like 1 in 45 million.
And there's also a growing debate around the nature of mystery bundles or in-game purchases. The example of Max buying football player mystery bundles is a good one.
Because the buyer pays a fixed amount, but the outcome, which player they get, is uncertain.
The activity results in a win, a rare player, or a loss, a useless player. It fits the core definition of gambling, and it introduces unregulated financial risk to younger generations.
Given all these risks, how do we protect ourselves and our assets? The first line of defense against unexpected calamity is insurance.
This is a guarantee of compensation for specified loss, damage, or illness in return for you paying a regular premium.
The sources introduce the important concept of self-insuring. What's that?
It means deciding not to pay the premium to an insurance company and instead setting aside that money each month into your own high-interest savings account. The goal is to build up enough cash to cover the cost of replacing or repairing the item yourself if something goes wrong.
But before you self-insure, you have to rigorously ask yourself a very tough question.
If my house burns down or my car is totaled, or I face a catastrophic medical event, do I have enough readily available savings right now to cover that massive unplanned bill without going into debt?
For risks that are expensive but relatively rare, like replacing a phone self-insuring, might be viable. But for risks that are genuinely catastrophic,
Like major illness or your house burning down, insurance is almost certainly a necessary, non-negotiable expense.
and finally, we can revisit the protection offered by consumer law, specifically LOIF, which ensures you get value for money and have recourse if goods or services aren't fit for purpose. It's a system designed to protect your capital.
Okay, let's talk about earning money and making sure you know exactly what you are taking home. This is essential for accurate budgeting. When you start working, you'll get a pay slip detailing your gross pay versus your net pay.
So gross pay is your total income before any deductions are made.
And net pay, or take-home pay, is the amount left that is actually paid into your bank account after all those deductions are removed. This system of taking deductions before you get your salary is called pay as you earn, or PAYE.
And the main deductions are compulsory. They're legally mandated by the government: income tax and national insurance.
Right. Income tax is set by the government, and everyone is allowed to earn a certain amount before they start paying it. This is the personal tax allowance.
And based on the UK sources, that allowance was £12,570 for the 2021-22 financial year for most people.
Any income you earn above that allowance is your taxable income, and this is where the fairness of tax banding comes in.
You can think of tax banding like a series of buckets that need to be filled. You don't just pay one flat rate on everything you earn.
Exactly right. You fill the first bucket, the personal allowance, at 0% tax. Only the income that overflows that first bucket spills into the next level, where the tax rate increases.
So the basic rate is 20% on taxable income up to a certain threshold. In the source, that's 50,270 pounds.
And only the income that exceeds that threshold then spills into the next higher rate bucket, which is taxed at 40%. The system is progressive. You only pay the higher rates on the portion of your income that falls into that specific band.
Let's use the source's worked example of a software developer earning 70,000 pounds a year. This often confuses people. They do not pay 40% on their entire 70,000 pound salary.
Far from it. They're still fully entitled to that 12,570 pound personal allowance at 0%. Then they pay 20% tax on the portion of their income between that allowance and the 50,270 pound threshold.
And only the income above that 50,000 mark, in this case 19,730 pounds, is taxed at the 40% higher rate.
This clear mechanism really dispels that common fear that earning £1 more will push your entire salary into a higher tax bracket. It just doesn't work like that.
What's the other compulsory deduction?
National insurance. This is a specific tax on earnings that's earmarked to contribute towards essential state benefits, primarily the state pension and sick pay.
And it's paid at approximately 12% until you reach the upper threshold, which aligns with the tax threshold, after which you pay a drastically reduced rate of 2% on any excess earnings.
Now, beyond earning and taxing, we must discuss security. Identity theft and fraud are rapidly growing financial risks.
Fraud is defined simply as dishonest deception for financial gain. And identity theft is the act of illegally obtaining your personal information, name, address, national insurance number, passwords, to commit that fraud.
The statistics really highlight the urgency here. The sources note that in 2019, over 223,000 cases of identity fraud were recorded in the UK, and crucially, 87% of that happened via online channels. This is a digital crime.
The methods of theft fall into three critical categories: physical, digital, and social.
Physical methods are the old-school scams, but they're still effective. Things like bank card skimming at fraudulent ATMs or shops where devices copy your card details. It also includes bin raiding, where thieves steal financial documents from your rubbish, and mail theft.
Digital methods are the technical threats: hacking, guessing weak passwords. It also covers malware viruses, worms that corrupt your systems or silently steal sensitive data. And hackers often leverage information you willingly provide on social media to guess your security answers.
And finally, social methods, which rely purely on deception and manipulation. Phishing uses fake emails, often perfectly replicating your bank's branding to trick you into clicking a link and revealing your information.
And phishing refers to phone scams. Fraudsters call you, sometimes claiming you've been a victim of fraud or won a prize, and then urgently ask for your account details or passwords to verify your identity.
Protecting ourselves requires constant vigilance. The sources emphasize specific, actionable tips. Password security is huge. You must avoid the worst passwords list, like password123.
Always check for secure websites. Look for the HTTPS and the lock padlock symbol in the address bar, especially when you're making payments.
And crucially, limit the personal information you share on social media. Your mother's maiden name, your first car, your pet's name. These are often the security questions used by banks. Revealing them publicly makes a fraudster's job significantly easier.
And if you are victimized, the first rule is to ACT fast.
Contact your bank immediately to freeze your accounts. Review your credit report for any unrecognized accounts opened in your name.
And remember the absolute safety net offered by the Financial Services Compensation Scheme, or FSCS. This scheme protects your deposited money if your bank, building society, or credit union fails.
The protection limit is currently £85,000 per person, per institution. And this figure is critical because it dictates how you should manage large sums of savings.
So if you have substantial savings, say £150,000, you must spread that money across at least two different legally separate financial institutions
to ensure every single pound is fully protected by that FSCS guarantee. Relying on one institution risks losing the portion over £85,000 if they were to fail.
And that brings us to the close of this deep dive. We've covered the necessary financial foundations you need to navigate this complex landscape safely and successfully.
We've built the pillars of financial knowledge, understanding the exponential power of compound interest, the necessity of rigorous budgeting, the distinction between debt that serves you and debt that cripples you, how to assess risk, and the vital steps to protect your earnings and identity.
The actionable takeaway today connects right back to the central theme. Strong budgeting and comprehensive planning is your absolute best defense. It provides a crystal clear snapshot of your finances, forcing you to make informed, deliberate choices that protect you.
We saw that the entire foundation of modern finance rests on the bank's business model. They pay you, the saver, interest to attract your deposits, which they then lend to others at a significantly higher rate for profit. They are incentivized to keep that gap as wide as possible.
So what is this fundamental model, where the institution makes guaranteed money off the differential between saving and borrowing? Tell us about the ultimate power and responsibility of keeping your own finances sound.
It tells us that controlling your money flow isn't just about avoiding debt. It's about leveraging the system so that you are the one gaining the compound growth, rather than the one paying the compound costs.
It's always better, financially and psychologically, to be the lender than the borrower.
That's the powerful insight to mull over as you review your own budget and savings plan. Thank you for joining us for the deep dive.